Balancing production and the price of oil, set against a background of global competition and the battle for control. Can OPEC retain its influence as power increases outside the bloc? This is Inside Story. Hello and welcome to the programme. I'm Martine Dennis. Now, this is an industry that is plagued with uncertainty, with prices playing second fiddle to the fight for market share. OPEC ministers are meeting in Vienna on Friday to determine oil production for the coming months and, in turn, the price of oil, which of course affects us all. Recent strategy has been to carry on producing flat out, led by kingpin Saudi Arabia. But pressure is growing to tighten the taps and drive prices up. Now, it's been a tumultuous year for the oil market. The price of Brent crude hit a high of around $114 a barrel last June, before crashing spectacularly at the beginning of this year to $47. Now, the price has since stabilised at around $65 a barrel. But some OPEC members feel that a fairer price would be somewhere above the $75 mark. Now, OPEC's concern is that lowering the cost of oil risks letting in outside players like US shale oil producers and Russia. Then there are regional considerations. What happens as and when Libya and Iran are added to the equation, and Iraq's production when that increases? Now, OPEC's take here seems to be at odds with some of the other players, including the International Energy Agency.
Because, the production is going without any interruption, exporting is going without any interruption, everything is going very well. We have problems here and there, but remember that we are having this problem for so many years before. So there is enough supply, there is enough demand, and right now I don't see any major any negative effect on this, what happened in the Middle East right now.
Threats to supply also remain. And while the market is currently well supplied, as indicated by the recent drop in oil prices, political insecurity could potentially disrupt projected supply. For example, according to the IEA's 2015 medium-term oil market report, nearly 90% of OPEC capacity growth over the coming 5 years will come from Iraq, a country that faces numerous political and security challenges. And while Iraq's production has been impressive, given the political conditions the country is operating under, significant risks remain.
All right, let's bring in our guests now. Joining us from Riyadh, the Saudi capital, of course, we have Sfakianakis, a former advisor to the Saudi government, who's now Middle East director for the Ashmore Group. In Vienna, we have Sean Evers, managing partner at Gulf Intelligence. And in London, we have Mamdouh Salameh, an international oil economist who's worked as a consultant to the World Bank. Can I start with you, John, in Riyadh, because, of course, that is the capital of the most influential member of OPEC. What does this current meeting mean? How would you characterize this moment for OPEC?
I would say it's business as usual. For Saudi Arabia, they will push for maintaining market share, and at the same time, they will ask for no changes in terms of supplying additional oil, and they will continue with the same policy. And that is important given that market is indicating that oil is not going to collapse from here on. At $60 or $65 a barrel for Brent, it is okay for everybody. Of course, they would wish to have oil at a higher price to balance their fiscal situation. But again, I think it satisfies a lot of the participants, both producers and the consumers.
And Sean, so if the Saudis are going to lead the call within OPEC to maintain production of around 30 million barrels per day, that doesn't satisfy everyone in OPEC, does it? We heard earlier, at an earlier round, we heard there being complaints from other countries, like, for instance, from Venezuela. So how will those other countries square themselves with the Saudi call to maintain production?
Well, they really don't have much option because there's really no tool in their toolbox that they can take out to change the course of action in any direction. The point being that Saudi Arabia sort of is the leading policymaker in OPEC, and unless the only tool in the toolkit for OPEC in order to adjust price upwards is the oldest tool in the book, and that is to cut production. And typically that has always fallen back to Saudi Arabia to do. And on this occasion and on the last meeting in November, they're unwilling to do that anymore. And so all of the other OPEC members, at least for this current period of time, will just have to take it and hope that oil prices remain at $65 a barrel. Because one has to remember, by OPEC deciding to do nothing when they meet tomorrow, they're actually de facto deciding to increase production by 1 million barrels a day. Because if you assume that Iran will return to the international markets with the lifting of sanctions after June 30th deadline with the nuclear talks, the Iranian oil minister told OPEC yesterday that he was going to be able to add 1 million barrels of production over the next 6 months. So that is a +1 to the market.
OK, but Sean, can we deal with the Iranian situation a little later on in the programme? Because, Mamdouh, I'd like to talk to you about the existing policy that's been pursued by Saudi Arabia and ask you whether there's any evidence that it's actually worked. Has maintaining oil production, has it actually worked?
The price of oil has risen by 30% in January to $65 a barrel. That's an improvement, but OPEC needs much higher price than that. It needs a price above $100 to $110 because they need these prices to balance their budgets. Now, the Saudis say that keeping the price low will slow down, if not kill, the U.S. shale production. That is not working. It's true that the number of rigs in the United States has declined by more than 60%, from 1,609 to around 644 now since October last year. But we must remember that the price will eventually go up, and with it, the U.S. shale oil production. So the best action, in my opinion, was OPEC to cut production by at least 2 million barrels a day, which is the amount they are already overproducing, above 30 million. So there is a compromise in OPEC between those who oppose the cuts like Saudi Arabia and those who lead for the cut of production like Iran and the majority of OPEC. There is a compromise.
OK. Can I take that point? It's a very good point you're making, and put that to John in Riyadh, because what Mamdouh is pointing out is this vast difference between the Gulf members of OPEC and the others, like, as I mentioned before, Venezuela, Nigeria, Angola. There is a huge difference, isn't there, in perception as to how to manage the issue of oil.
You're right. This happens perennially at OPEC. So there will be differences and disappointments. And I'm sorry to say to the other countries that will not follow with what Saudi Arabia says, Saudi Arabia will influence most of the countries, and tomorrow they will decide that there will be no increase in policy or decrease in policy. It will be business as usual, as I said, only because if we do go back to what Saudi Arabia reverted in the 1980s, the policy of decreasing output as there was pressure on prices, it fell tremendously, the pricing mechanism, and prices collapsed from $30 to $10. And that completely destroyed the market share of everyone. So right now, I think what is important is to maintain market share because of exactly what was said before, which is the concern of others like Venezuela and Angola, taking and tapping into those markets that Saudi Arabia and the other Gulf producing countries. To the point about fiscal disequilibria or fiscal adjustments, well, the Gulf countries have to spend less than what they're used to, as well as Venezuela, Angola, and many other countries. It has been a good 10-year rally, and now they have to adjust their fiscal appetites.
Well, it's been a while since OPEC was established. The Organization of the Petroleum Exporting Countries was formed at the Baghdad Conference in 1960. The founding members were Saudi Arabia, Iran, Iraq, Kuwait and Venezuela. The group quickly expanded and currently includes 12 countries, adding more members from the Middle East and Africa, as well as Ecuador. Its goal has been to set production limits and oil prices to best support producers and consumers. And while OPEC still accounts for about 40% of the world's supply, it's operating in a far different world than the one it started out in more than half a century ago. So, Sean, picking up on that then, how much pressure would you say there is upon OPEC right now from those countries outside of the cabal of non-OPEC oil-producing countries like Russia, the United States, Canada, Norway?
I mean, there certainly would be hope or a certain level of wish that OPEC would resort to its sort of long-held position in the market of managing supply so that one can and everybody can enjoy a maximum price. But I think everybody now understands that that period, at least for now, is over, and that they have to adapt and accept that really the open market, like most other products and services in the world, is determined by the old reliable supply and demand. And one thing that's in Saudi's favor, if you like, at this moment in Vienna this week is that oil price has recovered more than 30% since the low earlier this year. So they have a somewhat positive narrative to share with everybody. You know, $65 on Brent price is a lot better than $45. So in the last 2 days, as OPEC has met here in Vienna, there hasn't been a lot of sort of dissent and stress from the less well-off members of OPEC. Everybody is more or less accepting the current strategy and realizing that in the longer term, market share is really critical. OPEC's market share you mentioned that it's been in existence for 50 plus years. Its market share has more than halved over that period, has fallen by half. So they've got something to protect, and this is some strategy over the long term to achieve that.
And Mamdouh, in London, despite the fact that prices have stabilised and regained some ground, it's still lost an overwhelming amount, hasn't it, within the space of a year. And that's had material damage, hasn't it, to many economies, many of the more precarious economies that depend rather heavily upon oil production. And so how can we quantify the costs then to some of these economies, the more fragile economies?
Well, let me tell you that the global economy cannot reconcile itself with the current low oil prices, because the main ingredients of the global economy, like the oil industry, like global investment, and the economies of the oil-producing countries will succumb to or will be undermined. For instance, we have seen a cut by more than $53 billion in global investments. We know also that the oil industry needs a price of $125 to $135 a barrel to balance their books. And of course, we have seen the suffering of many of the oil producers. Consequently, in my opinion as an economist, I say that an acceptable price should be between $100 and $110 a barrel. That price enables members of OPEC to expand their production capacity and to explore for oil, and it gives them an excellent revenue. For the global economy, I am sure it is capable of absorbing a price of $100 to $110 without any problem. They say that the lower price of oil helps the economy. I counterbalance that by saying, though oil goes into manufacturing and therefore it helps the global economy, the cut in the global investments, which makes many companies reduce their sizes and sell assets and make thousands, if not millions of people redundant, cancel that advantage. So the global economy needs a reasonable price to flourish, and the price I am suggesting is $100 to $100.
Okay, well, that's something perhaps that you might get a lot of support on, because even the wealthier countries, even the Gulf countries, have been suffering as a consequence of this radically reduced price of a barrel of oil. Qatar's oil minister had this to say in Vienna this week.
As you all aware, the last 9 months or so have been particularly challenging for the oil industry. The crude oil prices lost half their value, and the relative stability seen in oil markets over the previous years was upset. It has proved to be an especially difficult time for some of the industry's main stakeholders, resulting in revenue and job losses and threatening investment in a future production capacity.
Well, that was the Qatari oil minister, and apologies for the rather poor quality of the sound there. And John, in Riyadh, so even the wealthy countries have had to absorb, have had to suffer the effect of this downturn in prices. How has that actually manifested itself in Saudi, the great giant of OPEC and the great giant of the Gulf?
Well, this year they will run a fiscal deficit close to 20% of their GDP. There will be a substantial overspending that is going to be done, and it's only going to be covered by either two things. Probably both of them will be done later this year: issue debt and also use the reserves. Reserves have been increasing over the last 10 years, and now it's time for them to be deployed in a counter-cyclical way. So they have to adjust, and like other Gulf countries, they have to spend less and use more of the reserves. But at the same time, oil is a cyclical business. So we're now in the down cycle, and all these economies have to think about, again, the lofty goals of diversification. It's difficult. It's easier said than done. But I don't necessarily think that anybody, especially Saudi Arabia, is calling for oil at 100, 110 or 120. In fact, when Oil Minister Naimi was asked the other day, he didn't specify. And I think the Saudi oil policy today is not to indicate about where oil is going to be.
But John, wouldn't a high price for a barrel, of course, benefit the Saudis as much as it would any of the other OPEC members? Why are the Saudis not prepared to commit themselves to a price?
Because I think this is new in terms of how Saudi perceives the world of energy and the world of oil. It does not want to continue saying that oil at 100 or oil at 80 is a fair price, because usually it goes both ways. It either overshoots or it undershoots. So I think now it's neither prudent nor necessary to say that oil is good at 70 or 80. So they don't want to signal where it's good for Saudi Arabia so that it leads the market. I think it's much more normal, as was said before, that supply and demand is a more powerful dynamic to determine price than for Saudi Arabia to say that it wishes to see oil at 100.
And Sean, a little bit earlier you alluded to the possibility of the Iranians coming much more on stream, because the expectation, I guess, is at this moment that the deal with the 5 permanent members of the UN plus Germany will come to some kind of fruition, and that they will be allowed to produce more oil. What kind of impact then is that likely to have upon OPEC and the dynamic within the 12 members?
Well, just to reiterate, the Iranian oil minister was saying yesterday quite confidently that that is indeed what will happen, that within 1 month they'll be able to add 500,000 barrels of a day capacity back on their production, and within 6 months up to 1 million. So that would bring them back to the levels they were at in 2012 before the last round of sanctions were quite crippling. That, of course, if you take it again on the pure economics, nothing else changes supply and demand. That's a lot more supply, and typically when that happens, prices decline. I mean, there is the unknown component in all of this, in the sense that the political risk, the geopolitical risk premium, as it's known within the oil price at the moment, is rather deflated. His Excellency Ali Al-Naimi was asked about that yesterday. Was there any geopolitical premium in the oil price? And he said there was, but it was very, very little one, because everybody's quite comfortable with the current risk profile. But of course, that could change at any point. But if you take everything as it stands, all being equal, if you add an extra 1 million barrels a day of supply on top of the extra 2 plus 5 million barrels, as it's generally recognized at the moment, of oversupply, you're going to have a very soft oil price. And we could test lows of 50 and 45 as we tested earlier in the year. So we'll have to see how quickly Iran does actually come back onto the market.
What about, Mamdouh, what about the emergence of the large number of shale oil producers in North America? What effect is that having on the market overall?
It has already had a big effect, because shale oil production in the United States has grown from less than 700,000 barrels a day to around 3.5 million barrels a day, which is monumental in a short period of time. However, neither OPEC's cutting prices will impact on the shale oil production. The only one which will impact on shale oil, U.S. shale oil production, is geology and the environmental backlash. As you appreciate, any well of shale oil loses 70 to 90% of depletion in the first year. So every 5 years, you need to drill far more wells to maintain production as it is. So it is geology which will kill in the coming future the shale oil production. It has already peaked, and it will start to decline from this year onward to less than 6.1 million barrels a day by around 2030, 35. So far the impact has been big on the global oil production. However, that impact will start to lessen gradually, and we should not exaggerate that impact on the oil price. What impacted more is overproduction by OPEC.
Okay, John, can I just ask you finally whether it's possible at this stage to envisage a future where we are not completely dependent upon oil, as we have been, of course, for a generation?
Of course. This is definitely happening. And there is today the production of a car that uses hydrogen, and that will happen over the next 50 years unavoidably. And to that effect, Minister Naimi said that Saudi Arabia is going to be exporting in the next 4 or 5 decades electricity, solar power, which is so prevalent in Saudi Arabia and the rest of the Middle East, than oil. And I think that the Middle Eastern countries have to realize that at some point, and other oil-producing countries, will be less needed because there are technology improvements. As, for instance, shale is becoming cheaper, so is everything else in terms of renewables. And so we could be going into the next 50 years something new.
Okay, and Sean, in Vienna, can I ask you then whether you think that OPEC is up to the task? Because it seems to me that it has to be particularly nimble to adjust at this particular moment in time.
Well, I think OPEC has seen much more challenging days. When I first started covering OPEC in the mid-late 90s, oil prices fell to $10 a barrel. And over about a 5 or 6 year period, under the direction of Ali Al-Naimi, they managed to recover and back up to 25, and then the journey climbed beyond that up to 100. So OPEC has seen challenging days in the past, and I don't think this one is overwhelming. It's clearly a passage that has to be
tackled. All right, Sean, thank you very much indeed. Very interesting points. We have to leave it there. I'm afraid we're out of time. So Sean Evers in Vienna, thank you very much indeed. Mamdouh Salameh in London, thank you as well. And as ever to John Sfakianakis in Riyadh, thank you very much indeed. And thank you for watching. As always, we'd like to hear your thoughts. Remember, you can get in touch with us at our programme page at aljazeera.com. You can also post your comments at facebook.com/AJ Inside Story, or you can tweet us at AJ Inside Story. But from me, Martine Dennis, and the whole Inside Story team for now, it's goodbye.